What's up, outliers? Happy Wednesday. I lost money on ASTS. It did me dirty. And I want to talk to you guys about the trade that did me in, the disrespect of ASTS. It's unbelievable, really. I want to talk about that because I think it's super important to talk about losing positions and the fact that that is part of the business. Anybody that has been around the community for a while, you know, also another piece of how I view losing trades is a lot of times they're literally more interesting to me than winning trades. And it's because typically with a losing trade, something somewhere didn't go to plan. And we'll talk about that. I also want to talk a little bit about Netflix and Netflix's earnings. If you did not see the live stream I did earlier for Irvin, where we discussed Netflix earnings a little bit, I'll recap that quickly. But the main point is tech itself continues to look really interesting and opportunistic to me. And then the last thing that I want to talk about was a question that I got from a community member about rolling options. So we have a decent list of items on the agenda for today. Looks like we got Lauren, ZX, Dark, Mark, IR2 Bad. Great to see you all. Hope the week is treating you well, and I hope today was nicer to you than it was to me with ASTS. First, before we revel in my pain, I want to talk about the broad market really quick at a high level. Again, I already kind of talked a little bit about this earlier today, so I am not super interested in going through all of that again, but I will give you a general run through. There is a recent piece of news that just broke that we need to talk about, and it is this. Actually, I just posted it in the Discord for everybody's general context, which is this. So this came out from Trump on Truth, and it says, based upon a very productive meeting that I had with Secretary General of NATO, Mark Rutte, we have formed the framework of a future deal with respect to Greenland, and in fact, the entire Arctic. This solution, if consummated, will be a great one for the United States and all NATO nations. Based on this understanding, I will not be imposing the tariffs that were scheduled to go into effect on 1 Feb. Additional discussions are being held concerning the Golden Dome as it pertains to Greenland. Further information will be made available as discussions progress, so on and so forth. Here's the funny bit. The funny bit is most people, and if you were in any of the live streams effectively from like Saturday on after this news broke, when we were talking about it, my underlying theme, and we talked about this actually in moderate detail yesterday, my underlying theme is that there were not going to be some sort of massive progressions of sanctions, tariffs, financial penalties of sorts. And I also do not think that there's this actual pursuit to like annex Greenland. I didn't see that happening and still don't see that happening. This is an artifact of the way that DJT likes to negotiate. And I'm not weighing in on, is this good negotiation? Is this bad negotiation? It is what it is. But the underlying theme that you can pull from is that when these kinds of pieces of information break, they're ultra tradable because, at least in my expectation, with this specific scenario of it being quite temporary, this seems to be starting to resolve faster than I expected. Full stop. I did not expect to see this come out quite as early as it did. I thought it would have lingered at least for a little while longer, just because we're not quite yet at the point of 1 Feb, and sometimes he'll try and squeeze out as much drama out of something to cause that mayhem. But everybody's familiar with this idea of like the taco trade, right? Like Trump always chickens out, which the nomenclature is funny to me. The reason why these things happen and why these things are announced in the way they are is because ultimately they work to what his desired end is, or at least towards that desired end. Now, I can't tell if this is simply a saving face thing, because this also does not look that firm, right? It's just a framework of a future deal. That's about as nebulous as I could possibly think the current state for a negotiation with the stakes that were given. But like we were talking about yesterday, from a militaristic and a defensive perspective, this is massively important. And the United States and really the rest of the NATO countries do absolutely benefit from a stronger position in Greenland. I'm not saying stronger position by the US, I mean in general, anybody that's aligned with those nations, because the position for Greenland, massive strategic importance for monitoring airspace, which again, I'm not going to go into super deep detail because we again literally just talked about all of that yesterday. However, the market is now showing us what the market thinks. And as per usual, I always find the initial reactions to this stuff and the way that the market behaves around this news, this kind of news, and the Trump presidency to be completely insufficient with respect to volatility levels. And I want to talk about VIX in this context. Let's take a look at VIX. And I'm actually going to use VIX futures just because it'll catch the time frame better. So everybody's plugging along. We all enjoy what's going on. Happy week, mellow, things grinding up. Trump starts saying, you know what, I'm going to escalate this Greenland thing and let's start, moving tariffs up to 200% for EU if they don't play ball. And market says, it's like that Sully meme that you see, just like that. So we get the Sully meme, and Vol has a pretty serious move. From where it opened to where it peaked, it ran just over 22%. Big move. It starts to look like it's settling down. The first thing, I do not think that this move was sufficient given what was going on. Yet I think the initial reaction was overdone relative to what it looked like was going to occur. What I found most interesting is the unwind. This unwind and this return, and now is a good time to look at VIX itself, this return essentially to prior levels with this thing still generally lingering it's literally illogical to me. That's the best way to describe it. I don't think it makes sense. And I'm very cautious to say that because I don't think I'm smarter than the market, and I don't think I'm smarter than all of the participants putting their money and setting up positions in here. But I do think, and I've said this before, that with products like VIX, SPX options, big vol products outright that are being traded outright, I think that there's a lot of confusion and confounding factors in other basic trades that continue to run. And what I mean by that is systematic strategies that are not necessarily meant to capitalize on some sort of catalyst, but they just continue to be what they are and trend that direction. And that has an impact on volatility. And we can see that if we turn it into a time series and plot something like vol of vol. If I show you VVIX and we zoom VVIX out longer term, the thing that is pretty cool is if you look at the total ranges that you see here, right? So I look at, where's my little Got like a little box drawn, this thing. If I draw to fit most of this stuff, and it's the range for most of this stuff, there's what? 137, 139 down to like 67, something like that. If I do the same over here and I try to get something of best fit for most of this, you can see the difference in the size of these boxes. This relative change in volatility of volatility is something I've been studying very deeply. And there's actually a lot of profit mechanisms that I've started extracting related to vol. That's not really anything suitable for the stream here. It's stuff that I'm still ironing out, and some of the stuff I'm still running it live myself. So in those instances, I typically do not want to go exceedingly deep into detail. But suffice it to say that this is a thing, and it's very, very clear to me that the way that volatility is being priced doesn't make a tremendous amount of sense to me. What does that lead to in terms of the move? Well, on the move today, this was a really, really, really easy trade. It's not a very profitable trade. It's a really boring trade. There's a bunch of different ways to run it, but anything in the volatility, and especially if you can get some sort of leverage on volatility, stuff like this has pretty good opportunity to trade vol, but we're now back down to effectively suppressed levels. Like 17 is still slightly higher than really long-term average in VIX. Again, if I zoom this out further, I got to go even further still because of what recently happened there. But super long-term here, it's like 18 and a half. And then if we look at like a 5-year time frame, it's a little bit elevated, like the 16, 17 handle, whereas the mean is like 1630. So it's still a little bit elevated there. But again, as I showed you on a really long-term time frame, it's actually a little bit low. So it's also like, what regime are you comparing it against? But this still seems a little bit low to me compared to like where base vol would likely live at this point. Across the sectors, a ton of trades, literally an absolute ton of trades. We just saw energy crack highs, materials crack highs. Here's the funny thing. Same thing with staples in its recovery. It didn't hit 6 months highs, but it did absolutely rally pretty hard over the last few days. A lot of people started to think with this talk about Greenland that there might be some sort of market rotation, defensive positioning of capital, but the extended moves on the day is actually like reconfiguring the way that I look at this, because it started based on potential defensive positioning. But then the fact that it still is holding these levels on the day when a lot of that is clearly abating, again, is telling. Futures right now, E-minis are up like 0.25%, Russell 0.14, NASDAQ is leading, and NASDAQ should lead right now. It would be weird if it didn't, because NASDAQ has been lagging the other two. And a lot of that has to do with tech, and we're going to talk about Netflix earnings in a moment. Hey, yo, what's up, Tom? Good to see you. Lauren says Iceland calls him daddy. Wait, do they really? That's actually hilarious if they do. Let's take a look at ASTS. ASTS is a fun trade that blew up beautifully in my face, as it were. And I want to talk to you about the position. So we started to get on the 15th a bit of a breakout. And on that breakout, I actually initiated my position, which was like midterm dated calls. Again, for most people, it would be longer dated calls. I was across a couple different expirations, but nothing, beyond 90 days. Most of it was near term And then everything from slightly in the money to slightly out of the money. This wasn't like some sort of huge position for me. It's just relative sizing to the portfolio. I typically spread across different strikes to get the total exposure I want without suppressing, well, really staying in one spot and just getting ripped apart on my entries. That's where it started. Got the gap up and began scaling in. So I added more on this day. We had a flat yesterday, which I actually thought was good. I thought that that was a positive scenario, that we were kind of flat yesterday when the rest of the market was looking really rough. And then today it started off okay. And then I was in meetings and calls, so I did not have a chance to manage it as it was breaking below my stop. And I ended up exiting towards the end of the day. The net loss on the position, I think it was like 0.5% of the portfolio is what it was supposed to be, and it came in at like 0.65%. The reason is because I missed the fucking stop. I was supposed to get out further up here, but I didn't, and that has an impact. Still well within the realm of possibility, still completely reasonable for the way that I trade breakouts, early breakouts in this context. Everything else looked completely okay. I actually still like this to the upside, but it's just not behaving correct right now. So while it's not behaving correct, that's why I pull the trade down. And I am actually setting up a couple new alerts in case it gets its life back together. A lot of the more volatility driven breakout plays that I recently had on, I had to take a lot of them down because of the way that the market was behaving. Those get hit pretty hard. So I'll show you a couple others like ONDS. ONDS has been relatively fine. I'm already out of here, but this is another one that I'm continuing to monitor because this, I think, has the potential for another pretty good leg up and a pretty good breakdown. The crux here is, I think, this is still too high in terms of daily ranges. I think these need to constrict a little bit before I would like actually begin expecting some sort of solid upside breakout. Sometimes it happens without doing that, but I typically wait to see that. And then another one, this one was actually a really, really good trade, was Rocket Lab. And as you can tell, I still have alerts sitting in Rocket Lab 100%. Am very interested in getting back into this name as well. But I came out of it yesterday. I think it was yesterday. And it was just taking profit before things started going down too much. This is just a generally more active style of trading for these kinds of things. It's not like a longer term sort of bit like what you guys see me doing with the covered strangle in stuff like IBIT and whatnot. So at the portfolio level right now, I'll give you some numbers. At the portfolio level right now, I am 84% utilized. So actually a little bit light, relative speaking. The market, S&P year to date, is down negative 0.05%. So the S&P is effectively flat. And then NASDAQ Qs is down 0.5%, technically 0.6%. And TQs is down almost 12%. IBIT is up 1.4%. VIX is up 13.8%. And IWM is up 8% on the year, which is really cool for IWM because IWM has been fucking sucking wind for some time now. So yeah, a lot of really, really interesting rotation undergoing in the market right now, which is very, very common, especially when you start to see one of the primary sectors, specifically tech, lagging a little bit, which it unequivocally is. I don't think that that bodes poor for Netflix in total, which again, we'll see in a little bit, but it does. And we've seen tech slowing down for a little while now. Okay, I want to talk just really quick about the IBIT covered strangle. And this is pretty much in a holding pattern. this still looks good to me. I still have, I'll tell you right now what the current utilization is. Current utilization is 82%. I have not made any adjustments just yet. What my plan is, and I was talking to the pro members about this, I think Sunday or yesterday, one of the two, but I'm essentially going to adjust the short put side of the position. And then the calls, I'm going to use that to subsidize the put side of the position. But the move today actually helps me just a little bit. At this point, it's kind of like sit and wait just a little while longer, because if it stays around where it is now, then I'm still relatively content. And for context, the short put side of the equation on IBIT, the return on invested capital is still over 2.5% for like a 35-day trade. That annualizes out to like 28%. It's completely reasonable. It's underlying itself is not doing great. So this isn't some sort of massive return engine. It's actually been slower on the coverage strangle front from that lens, but that's also why I'm much lighter in terms of how much is being used right now and then the overall equity utilization in it. Cryptocurrency's been really, really rough. But the good part is because it's been relatively rough, volatility is still pretty good. Now, again, implied volatility percentile is not good. It's low, but that doesn't ultimately matter as much because raw volatility is still 40%. That's still good vol. And this is why on something where the volatility is 40%, if we look at these, 30 delta puts that expire in 30 days, you're putting up 48.50, but you're making $123. That's still a really, really strong return annualized. Again, it's not like moonshot numbers, but in the context of short puts and stuff like that, that's pretty damn strong. Okay. Next, we need to talk about Netflix. Netflix had a good, bad earnings is generally what I saw. They came in at 56 cents. They were expected at 55. So small beat there. And their performance had a couple key trends. So the first one is revenue growth for 2025 was 16% year over year, which is good. Operating profit was up 30%, which is also good. Both of those are relatively strong performers, but that is slowing down, which is super important. Even big stuff like Netflix that seems like an absolute titan is not impervious to stagnation and then starting to slow. If you look at the long-term performance of Netflix over the past year, it's bad. If you bought Netflix a year ago and you looked at your account right now, you are down money. Not much. You're down like 0.5% based on the close of today. But that's a terrible return for allocating your money for an entire year and having quite literally nothing to walk away with. That's bad. The other thing is this kind of, oh, damn it. One sec. Wrong. Shit. Wrong thing. Want this thing. This kind of move, way too big. That's a 40% decline, 39% decline. That's way too big. When I'm looking at healthier pullbacks and stuff like that, 10%, 15%, maybe 20% in larger names like this, reasonable. But 40%, that's not good. That is a systematic repricing and expectation of the underlying that's undergoing there. This is not good by any stretch of the imagination. And again, if we think of like other tech names, let's just look at XLK over the same time frame. This is XLK over that same time frame. It's up 23%. It's a prime example of a laggard. Netflix is lagging its broader sector tremendously. It does not look good. Ad revenue and ad revenue growth looked fantastic. It grew 2.5 times in 2025, and it's expected to double again this year. That ad revenue is kind of its only lifeline right now. Subscriber growth is also slowing down. So partnerships, they're at like 325 million, which ads is down like significantly. So they're starting to hit saturation for their market, and now they need to optimize. That's kind of where they're at. They've gone through this massively aggressive growth cycle in terms of consumer and just customer acquisition. Now it's optimization. That's a tough bill because they're in a really expensive industry in order to optimize in some sort of meaningful way, which, by the way, my wife and I have been watching Kill Tony, the special, which is like a different stand-up comedians. Really, really funny. Overall, very good. Some super weird people, but I'm just stoked that that's on Netflix. I think that's cool. The other thing is price increases across Netflix. I actually don't know what the long-term price increases are. I'm going to ask, how has a Netflix subscription price or membership cost trended over the last 5 years? I don't know. Let's see. 2019 was $12.99 for standard, premium $15.99. 2020 was standard $13.99 up $1, premium $17.99 up $2. 2021 and early 2022 was $15.49 for standard, so up $1.50. And then premium was up another $2 to $19.99. And they introduced a basic with ads tier that's $6.99. It's kind of like fucking going back to cable. 2023, the basic ad-free tier was priced at $11.99 but was discontinued, so that wasn't successful for them. Ad-supported was $6.99. Standard, which is ad-free, stayed at $15.49, no change. Premium went up again by another $2. So effectively, each year from 2019 to 23, premium's gone up by $2 each year. 24, there's now ad-supported is $6.99, no change. Standard, $15.49, no change again for 2 years in a row. And then premium, no change again, $22.99. And then current, ad-supported, is $7.99, which is with ads. That's the first increase. Premium has gone up $1 and change. It's now $18, $17.99 from $15.49. So $2.50. That's a pretty big increase. And then premium is now, as you might have guessed, gone up another $2. If you look at those cost changes, that's them attempting to optimize their current audience. They've penetrated, they have users. And I've already told you guys, Netflix is the only like watching subscription that I have, that and YouTube Premium, which I think I tell you guys this joke all the time, but I find it absolutely hilarious that I was a millionaire for like half a decade before I was willing to buy premium on YouTube to get rid of the ads. And I watch a lot of YouTube, an absolute ton of YouTube, because that's where I can get like all the really cool documentaries and stuff that I like. I love like all the different kind of nature shows and all that shit. Super, super cool. Perfect place to get it. But anyways, I just thought that was so hilarious to me that I was so cheap and didn't want to get the ad free. I always used to use all these ways to like try to circumnavigate ads, which is why during our streams, there are no ads for you guys because I think they're fucking annoying. In the videos and recordings, you're on your own. But in the streams, at least, I run those ad free. All right, back to Netflix though. Back to Netflix. So subscriber growth, definitely still growing, but slowing down. Margin expansion is really what they're leaning on. They're targeting a 31.5% operating margin in 26, which is up from 29.5%. So again, think of the incremental changes that we're talking about here. We're talking about 2%, 2 points in this context. That move is not significant. You're looking at a maturing company. The reason why the maturing company concept here is really, really important is they are going to need to determine how they're going to run this ship. They're either going to have to find a brand new growth engine, which is part of what you're seeing in terms of the Warner Brother deal. But even that itself, there's a reason why that deal is going on. And I'm not positive that that's going to be some sort of like saving grace for Netflix. I actually think that that's probably going to be a bit challenging for them to do anything with. What did I see up here? Steve says, don't you think you can treat Netflix as a short trade? It's going to be 1 to 2 years with Warner Brother deal. Well, I guess it depends on the short trade and what you mean by that in terms of like short term or short. Because if I were to trade Netflix in any direction right now, it definitely would be to the downside. That's just based on, you know, what it's doing. I would not trade this to the upside. That's for sure. So yeah, I would definitely trade it to the downside. But as always, based on the move post earnings right now, this isn't where I would trade it. I would need to see how it digests from here. If it starts consolidating sideways and looks relatively weak, then yeah, definitely. I would have no problem fading it. It would actually fit the portfolio well. But because it had a pretty decent up day after the gap down on some strength, that leads me to believe that we're starting to get to a point in terms of people liking the price and liking the prospective value for it. So as long as that happens, I'm not as interested to trade it to the downside. I'm very selective on trading things to the downside. The thing to remember is like the base case for most companies is them growing and getting bigger and more profitable. Like that's the base case for most companies. That's why buying stock is materially easier for most people than selling stock. It's more intuitive and it's easier to be correct for sure. But the good part about short side and short selling is sometimes you can get a lot of magnitude. That's what I look for there. It's really, you know, designed to offset some of the risk in portfolio. But the way that I do that is from the magnitude it provides. I don't really like these long systemic shorts. Even with the last quarter in Netflix, I intermittently shorted Netflix, but nothing systemic across the quarter, which actually would have been a really, really good trade. Now that I look at it, hindsight always being as clear as it is. Reese says Netflix is comm services, right? I actually don't know exactly where it sits because I also know, well, something like Netflix sits in a bunch of different things. So Netflix sector. So it's in comm services and within QQQ, Netflix is, I'll tell you how much. Netflix is 2% of Qs. So still obviously heavy in tech, but within the S&P sector ETFs, it's in bucketed as comm services. That's what I see. Tom says Netflix going all cash deal for Warner, going to speed up merger, vote in March or April. Yeah. I agree with that for sure. Netflix is riding broadband rollout throughout the world. They can double subs over the next 5 years. You are, I don't know, actually. That's not a bad, that would be a really good line to make on like a betting market. Because could I see them doubling their subscriptions over the next 5 years? My instinct is extremely unlikely, but I do think, especially with the introduction of ad tiers, it would be very possible for them to penetrate less economically inclined places cheaper with that. But I'm not really sure how the economics of it would work for them other than just trying to get more subscribers. That could be the thing. And insurance companies do this a lot. A lot of places do this, where they will gain lines of business that they operate at break even or even slightly a net loss that are compensated for by other parts of the business to increase their footprint, which just net helps them. So that it could be a thing. But I also don't know what their current penetration is. So what is Netflix's current user penetration in terms of countries and percent users in each country? Let's see. I don't actually know. Steve says, seems like every time they get closer to closing up a deal, something else comes up. Yeah, well, especially big deals like that. That's really, really common. Okay. So in the US, they're at about 26%. In the UK, they're about 30. Germany is 21. Brazil is 8. France, 22. Mexico's higher than I thought at 12. India is 1. That's probably their best possible bet. The fact that India is at 1, I would agree with you, Tom. Like, if they can crack that India nut, my God, that's a huge potential market. Canada is like 25%. Japan is like 8. South Korea is like 17. So, yeah, I mean, I have to agree with you. Seeing the opportunity in India as big as that, that's massive. Only 1% in India with their population. I also don't know why it's just 1% though. That seems really, really low. And I don't actually know why that is so low. I'm going to ask that next. Why is India so low? So I have no context there. Tom says Netflix licensed content from Warner Brothers. They save that cost after the merger. Yeah. They do save that after the merger for sure, but now they carry all of the overhead. I don't think that the merger is a bad deal for them at all. Like, I think that the merger makes sense. I just don't think it materially changes the business that well. Because, yeah, they'll save that cost, but it's going to take them years to make that cost back up. They're not going to make that in the first few years. So, okay. Interesting. It's kind of what I was thinking for the less developed countries. This says Netflix India plans are cheap by US standards, but expensive relative to local income. This is exactly what I was expecting. It's 199 to 649 rupees. Netflix plan competes with services that are 99 to 149. So way cheaper, way cheaper. On a purchasing power basis, Netflix is a premium luxury product in India. That's exactly what I was expecting, because the cost to produce this stuff is going to be high. That, I mean, think of it that way. They obviously have a massive market opportunity in India, but it literally doesn't seem like they're able to do it in a cost-effective manner to like pull anything meaningful from it, which is actually really, really interesting. All right. I want to talk a little bit about rolling options, and I'm going to let them know I hit this on the stream tonight. And how far in are we? We are, wait, what time is it? 39. Around 47 minutes in. So this was the question that I got from one of our pro members, and I want to talk about it with you guys because it's a good question and something that I imagine a lot of people deal with at different levels, I should say. Okay. So TCM says, I'm trying to learn the art of when to manage a short option once being challenged. I've searched and watched all the rolling videos. From those I mostly see manage them when they are challenged, which is actually kind of funny because I actually wouldn't agree with that personally as like the takeaway from the videos. And for the context here is the, hold on, it's not letting me paste them all because it only lets you paste like a handful of things at once. All right, so there's the first video. Here is, oh, Jesus Christ. This is painful. All right, I literally got to do it this way. Here's the second video. These are like the citation videos that I think are good watches with respect to rolling options. This one and then one more here. Okay. So the first part of the question is, I mostly see you say you manage them when they're challenged. And that's, again, I wouldn't agree with that characterization. What I would say is when you first analyze them to determine rolling and stuff, when they're challenged is kind of like the first shot across the bow that you probably need to do something. But that's not inherently when I choose to manage them. And again, this is in the context, and more often than not, this is in the context of rolling losing positions. That's kind of like the subtext. A lot of times I roll options that aren't losers literally at all. I roll winning trades all the time, but we don't commonly refer to that as rolling. And again, this is because of the psychotic mental state that people have around rolling. If they're closing a winning trade and repositioning it, well, that's closing a winner and opening a new trade. Yet if it's a losing trade, we call that rolling, which is hilarious to me. It just shows that people struggle so much with acknowledging what's actually happening with the roll. But I digress. Essentially, for the first part is when the stock price equals your strike price is when you have the most opportunity, when stock equals strike. And there's a very particular reason for this. And again, this is in the context of a losing trade. Realistically speaking, the time that you would have the absolute best opportunity is when your strike is far out of the money. That means that you're sitting on a winning short option that you could just close at a profit and put further out in time, right? So like theoretically, that is absolutely the best possible time. But in the context of being challenged, which is what we're more often than not referring to rolling in, it's here. So what this means is if I like sold a 30 delta call and now it's at a 45 delta, this is when it's getting time to do something. What this is saying is that the underlying has moved against me. So if this is the stock price, it means that I sold the call at this point and the underlying has done this. So now I'm being challenged and I'm at a point where I have to start making some decisions. And obviously it's the inverse for the puts. It means if I sold a put, that the underlying had trickled down. The reason why this is the case is because here is where you have the most extrinsic value and, more importantly, no intrinsic value. Because here's what happens. When we roll an option, we have to buy it back. But if something is in the money, you have to buy back intrinsic value. If you buy back intrinsic value, you don't get anything for that. That's not what you're selling. When you're selling options, you're selling extrinsic value. So it's just a cost that you have to eat, and then you have to overcome that by getting enough extrinsic value to compensate for how intrinsic you are. What that means is you have to go further out in time. So that's why you'll hear me often say that I absolutely begin looking at what I want to do around that point. But it's not necessarily where I'm going to make the decision. And a lot of that depends on what the underlying is doing, what the portfolio is doing, what I think the underlying is going to do, and all that shit. So that's the first thing. The second thing is once they go in the money, you start rolling out. I also wouldn't characterize it like that, right? Like I was just explaining, it's completely context dependent. And it also is completely dependent. And some of the videos that I listed there go through this actually quite in detail, which is it depends on what I'm trying to accomplish with the roll. Sometimes what I'm trying to do is get a bigger basis adjustment. That's kind of a certain playbook. Other times I'm looking to actually increase my total profitability. A great example of this is actually somebody in the Pro Plus community during the workshop, the Zoom workshop that we did on Monday as a group. We were reviewing one of their trades, which was a ratio call diagonal in gold. They have long options with some short options against them. Well, one of the things that we're looking at in terms of how to potentially manage that position is what is the goal against the larger expectation? Do I think this thing is going to continue to skyrocket up? And if so, I don't really want short calls. So in that context, I might be looking to try to size them down, or I might be looking to just get a better basis adjustment to improve my total profitability versus anything else. And I actually think it still might be in the Analyze tab if we pull it up real quick. Hold on. Ah, bummer, it's not. Well, we did look at it. And essentially, the takeaway from that conversation for that individual position against that person's expectations is that they thought it was still going to go up. So in that kind of scenario, it might make sense to go out and up. But in terms of like rolling direction, it all depends on the purpose. Like I said, the most common rolls I do are profitable, meaning things that have gone in my direction, and I'm just rebalancing my deltas. So I would say in general, if I look at the broad number of rolls, it's actually not rolling out. It's actually staying in the same expiration. And if it's on the put side, it's rolling up. If it's on the call side, it's rolling down to capture profit. And it's not even to capture the profit. I don't care about that. It's to regain the deltas that I want. So here's what I mean by that. If we'll just stay in GLD because we're here. If I originally sell the 428 puts and they're a 30 delta, that means I have 30 deltas. That means if the underlying goes up by $1, I get 30 cents, which is kind of a shit deal, but that's just part of how this equation works because you also get theta. If the underlying moves in my direction, let's say that the underlying moves 8 points in my direction. What that means is my 428 put is going to look like the 420 put. So I'm going to use this as a surrogate option to assess what my 428s might look like if the underlying went up 8 points. And you can see what happens to my deltas. I go from 0.3 down to 0.21. So what just happened? I lost 9 deltas. So I started off where I would make 30 cents if the underlying goes $1. Now I'm getting 21 cents. That is a massive discount, a 30% discount to where I started. By rolling my option, same expiration, but rolling my option up, I regain those deltas that I want. Very, very frequently, that's what I'm doing. So I don't really just default to like rolling out, up, any of those. It's 100% context dependent. And then the follow on here is how would I go about deciding between waiting closer to expiration versus immediately rolling once they go into the money? And again, I highly recommend checking out those videos again because it talks about this exact balance and how to think about making this decision because it's a tough one. The Cliff Notes version is if I'm rolling in general, I have to pay attention to what I think the underlying is going to do. But then I also need to pay attention to what the market gives me. Here's an example. If I'm trading something liquid like GLD, let's say I sell the 30 delta puts, and let's say that they're now at the money and I decide that I want to roll them. Well, the cool part with something like GLD is I can roll out just a little bit in time, and I don't have to add a ton of duration right away. I refer to this as expiration liquidity. If I'm trading something like, what's something, this is better. Something like Rocket Lab. As soon as I get past this 58 DTE, I'm immediately super far out in time. I run out of expiration liquidity. So the trade-off here is by just literally thinking through the pros and cons. So let's think about it. For the pro side of the equation, let's get rid of this. For the pro side of the equation, and we're going to talk about short option challenged. We have two COAs, we have roll, and we have wait. Let's talk about first the pros for both. The pro for rolling is I minimize initial risk of falling in the money by moving my strike further out. That's the first and the primary benefit. If I wait, the main pro is I reduce my cost to buy to close. I'm not worrying about if it goes in my favor or if it goes against me. That is also a thing, but it can be a pro or con for both. So I'm not bothering adding that. This is the main pro, is that it gets cheaper if price stays the same and you buy to close a little bit later. What's the con? Well, if you roll early, now you immediately increase duration, you decrease theta decay, and again, this decreased theta decay is relative, because if I take something that's really deep in the money, let's say that we're in the 16 DTE, and let's say that we're way down here, and my theta for these really deep in the money options like the 65s, this says my theta is 26 cents. It's not 26 cents. There's literally not that much extrinsic value in these. It actually, no, I don't think so, because 16 days, that's way too much. It'll be less than that. It's some figure less than that. I don't know what. But if we close out of those and we go out 58 days and we move to something that's like at the money by going further out in time, this says theta is 13 cents, which would be higher than that other one. So again, in that context, I actually might be increasing my gross theta. But by being out here compared to here at the money, regardless, I am decreasing my theta compared to not going as far out in time. And that matters because if you roll too early, you're slowing down, well, you're really kind of decreasing what can end up happening to benefit your position and buying it back ideally at a better price. So you're going to decrease your gross theta decay in most instances, not all. The other con is that you can still fall in the money. The other benefit here I forgot to add is better basis. So not just in terms of the risk of falling in the money, but also your profitability. If I roll my strike out and up, I actually make more money if I'm assigned anyways. So that's a benefit there. What's the con? The main con to waiting is you fall deep in the money. This is the main con. If you wait and the underlying has an aggressive move against you, you just fall deeper in the money. And like we talked about before, you're now buying back intrinsic value, which you can't really capture. You have to overcome that with theta. You might have to go further out in time and all that other shit. So this is exactly what you should be looking for to make the decision. You have to analyze, and based on what you think is going to happen, you're striking a balance between all of these. More often than not, from a personal lens, if I have something that's like 30 days out and it's at the money, a good example is the IBIT covered strangle. This is literally a perfect example because I am at the money. I am at the 51s. I sold these originally for a 30 delta. They're at a 46 delta now. It's gone against me. I'm not doing anything. And it's because what I like to do is monitor what kind of roles are available to me in different circumstances. And as long as I'm okay with the potential roles, then I allow myself to wait. But if I'm not okay with the potential roles, then I know without a doubt it's time for me to do something. And this is, again, not factoring in what I need for the portfolio, if I have some sort of particular preference for the underlying, an inventory preference, that kind of stuff. So this is what I mean by that. Right now, if I look at what I sold those for, I sold them for $1.37. Let me grab this workbook so I can show you guys. Yeah. I think it might actually be in here somewhere. Yeah, it's right here. Let's get rid of all this shit. All right. So this is from the sample portfolio, which is a subset of my broader portfolio. And I'm literally copying in the position, 51 puts. This is an 8 lot in there, and it's for $1.37. All right. So what I do is I analyze what I would have to close it for first. So the midpoint is 219. The natural is 221. My guess is that like 220 is a fair price to look at. So minus 2.2. I now immediately can determine how much money I need to pull in from my next option in order to get to a break-even point. And again, this depends on if I'm trying to increase profitability or maximize profitability of the existing trade, and it's based on what I think is going to happen. But the main point here is I see, okay, $6.64, that's effectively what I need in total. And let's say if I go out to 58 days and I look at something like the 47s, which is a 27 delta. This is another thing that a lot of people don't know, is that you do not need to roll for a net credit. It's a really, really common misunderstanding. It's not a bad thing to do. It's not going to hurt you, but you absolutely do not need to do it. And you just need to actually track the math of what you're doing. So this is in 20 March. And now I am looking at the 47 puts for like $1.60. So 47 puts, I would keep it at the same size, and we're going to look to get $1.60. So you can see that I'm net positive on that position. I effectively just need to take in 77 cents in order for me to be at break even. So I can look out and see where I would get that. Maybe the 45s where I get $1.13. So the 45 puts and I get $1.13. I still walk out with a small profit, but more importantly, the most important part is I will have moved my strike meaningfully, 11.7%. I go from 51 puts to 45. So by analyzing what roles are available to me, even though that this option is at the money, it was just in the money that long ago, I'm not in any rush. I have choices available to me. Now, as soon as I start to see it falling in the money, even if it's at 30 days, I'm not going to wait too long, because if it goes too far in the money, and my expectation in this example would be that I think it might continue to go down in some sort of aggressive manner. Well, again, I don't want to buy back a bunch of intrinsic value. If I'm doing that, it makes it more and more difficult for me to get some sort of good basis adjustment. Again, let's take a look at a scenario. Let's say I'm asleep at the wheel. And let's say that I end up with this 80 delta option. We'll do the 55, 73 delta option, because no, let's go further in the money. Let's do like the 58s. So the 58 puts, I would have to buy them for 720. Let's just say that they fell really, really far in the money. In order for me to get to break even at the same size, I need to make 46 total in credit. Break even would have to be something around $5. So if I go out to 58 and I look for where can I get to that break-even credit keeping same size, I need $5.83. Where do I get that? $5.83 isn't until right here. So the 56s. Well, what's the rub? Well, the rub there is if I go back here, I'm moving down 2 points. Whereas in the other scenario that I just showed you, I moved by 6 points. That's the dance that we dance with this. So in terms of like building that into the plan, you have to figure out a methodology to create a framework around that to be consistent. And that can be really whatever works for you and whatever your individual strategy looks like. And then there was one follow-up here that is worth covering quickly. This guy. And also, if I sound funny, I apologize. Right now, the gland on my left side of my neck is super fucking swollen. I have no idea what its issue is, but it is not happy. So I had asked them essentially, like, what did you take away from the videos that I shared? And that's more just for me to better understand how they're perceiving and receiving the stuff that I'm saying. And here they say, I think the big picture is you say, what do you think about the underlying? Which that's perfect. That's exactly correct. And I just lack confidence, knowledge in really deciphering that, which is a completely fair and really important description to come across. And in that scenario, if we find ourselves there, what does that tell us? Well, the very first thing we need to do is work on building that out. And how do we build that out? By getting in repetitions. How do we get in repetitions? We look at different things that we might want to sell, options, calls, or puts, or whatever it is that you want to sell, and tracking them. It's not stuff that you actually put on because you probably run out of capital and you don't have to test it on everything. But that's the spirit, is you need to look at tons of them. And as you look at tons of them, you will develop a better and better understanding of how they behave and how you might want to manage them. So that's the do the work part in the outlier strategy process. Because really that's what this is. We're talking about a very specific step right now in the outlier strategy process where we're testing different structures and building a strategy from them. And part of a strategy is, how do we manage this thing? What do we use to make decisions? And the next one, it says, you mention when they are at or just in the money to consider rolling. And I assume you mean at any time, regardless of DTE and not just at expiration. And I think we covered that before. It's really a delicate balance. And a lot of it comes down to expiration liquidity, what's offered. First one, you say if basis adjusts priority, do XYZ, but I'm not always sure when I should or would want that to be a preference over something else. This goes back to completing the outlier strategy process. If you analyze that management methodology and you assess the long-term impact on profitability, that will answer the question for you. The reason why there's doubt here, which is really, really fair, is there are points in the decision cycle that we don't have a data reference for, so then we're not confident in it, which is completely fair. And they add, my coworker says I'm a min-maxer, so sometimes I overthink everything because there's so many different options. And that's not the case here. I actually would say that this is even underthinking it, because this all should be done in the outlier strategy process. And again, that's just a framework. You can do whatever the fuck you want for strategy development. But the main thing there is that there's no point in this exercise that we should just be guessing. Like, should I roll now or should I do blank? That's a terrible, terrible methodology. And the two main pain points that TCM is suffering, and really, really good for them to identify, is lack of confidence in analyzing and understanding what the underlying might do in the context of their strategy. And then the second part that needs to be completed here in order to have good answers is they need to test it. They need to test different management approaches and then observe the results. It's the only possible way to get information to actually answer this objectively and accurately. Otherwise, it's just guessing. You can use your intuition to make it more efficient. So for example, if I'm trading a breakout style strategy and I have a ratio call diagonal on, I already know intuitively the breakout profit mechanism is based on velocity to the upside in shorter term timeframes. So the way that I might intuitively manage the short calls in a ratio call diagonal in that context that went underwater is very specific based on that context. So I can short it, right? I can figure out what might make the most sense and then just test a smaller grouping of things. But the only possible way to get to a good answer here is to test it. And the best way to test it is to try and back test it. That gets really, really clunky because you have to get a bunch of options data and then you have to get really good at coding in order to do anything like that, which is difficult. The other thing that you can do that's a little more accessible to most people, it's suboptimal, but it's fine, is go into on demand on Thinkorswim. It's free to access. Go into on demand. Find different points where the underlying goes down. So right here, we know IBIT started to decline on, what is this? 29 of last year of October. Sell puts. Build a trade log, just like I showed you here. This, and test different versions of it. So what I would do is copy and paste this multiple times. And by doing that, or really what I would do is if it's like a covered strangle or whatever the actual strategy is, I would build something like this and then just do it multiple times. So multiple versions of the same thing and do it a lot. It's going to take you literally hours, especially if you're doing it more manual like this than actually back testing it. It's literally going to be hours, but that's the cost to play this game. There's not going to be just, information, really, really profitable information that's just out there to pick up. I think I do a pretty good service in terms of trying to shortcut stuff for people, but I still don't give definitive outright answers in a lot of this stuff for two reasons. One, it's most of this shit is super context dependent, but the second thing is there's got to be a minimum buy-in for somebody to do this stuff. And obviously this isn't directed at any one individual. This is just the concept in general of how to get to the bottom of this. And that's exactly how you get to the bottom of those questions. Now, what I want to say is for TCM, if you make a little bit of progress on that over the next couple of days, we can absolutely go through a skill development segment and really hone in on rolling options. I actually am going to do that one for tomorrow, but that's just to help you create a better framework on like this specific study approach. And from there, we'll be able to compound on it from that point. So as always, if you guys need anything, hit me up in the Discord, be an outlier. I'll see y'all later.